Three friends, same background, same love for the food they grew up eating. They turned that into a business. It feels like something you'd root for immediately. At first, this sounds like the perfect story, but the deeper you look, the less it feels like a feel-good story. It starts to look more like a warning. At the peak of their success, analysts praised them when they first went public on the New York Stock Exchange. Their IPO was underpriced at first, and when it opened, it was sold at double the price. In recent times, critics have said they are overpriced. What exactly happened? How did this company that single-handedly turned around the IPO slump when it first went public now suffer from year-on-year losses and a dip in stock prices? This is what happens when a $10 billion dream runs straight into reality. This is Cava, the restaurant chain people once called the next Chipotle. The company is a US-based fast casual chain focused on Mediterranean cuisine. Today, it has over 300 restaurants across the United States. But it didn't start that way. It started in 2006 with a single location in Rockville, Maryland. It began with three friends, Ted Zenoristos, E. Grigoropoulos, and Dimitri Moshevitis. They had two things in common: Greek heritage and childhood spent around restaurants. They grew up in it: kitchens, customers, long shifts. So this wasn't some random experiment. They knew food, and people responded to it. Before Cava became a national brand, it was just a local sit-down spot called Cava Mezzi, and what really got people talking wasn't the full menu, it was the dips. That's what set everything off. Customers couldn't get enough of them, so the founders started packaging them and selling them in supermarkets. Crazy Feta, hummus, tzatziki, those were the moneymakers. Retail distribution gave them reach way beyond their dining room. Then, about a year after they opened, someone new walked in. In 2007, Brett Schulman joined the picture. He wasn't a chef, but he understood business, scaling, growth. Brett Schulman later became the chief executive officer and co-founder of what's now Cava Group. When he came in, he pushed to turn this small regional restaurant into something much bigger, a national fast casual brand. By 2010, Cava Mezzi Grill was born, and this looked very different from the original sit-down restaurant. This is when people started whispering, "Is this the next Chipotle?" They introduced build your own bowls. You walk in, pick your base, your protein, your dips, your toppings, full customization. That model worked. It felt familiar, but different enough. They were basically the Chipotle of Greek food, and the timing mattered. During the 2010s, many people were tired of burgers and fries. Fast food fatigue was real. Consumers were paying more attention to health, ingredients, calories, what they were putting into their bodies. The market began to see a shift due to the changes in customer preferences. There was increased awareness of the need to be more health-focused around this time, which gave Cava the edge it needed to make its mark in the market. So instead of McDonald's, Burger King, or Wendy's, people looked for something that felt fresher, still quick, still convenient, just without the same guilt. Cava positioned itself as a Mediterranean wellness option. You could grab Greek food on the go, take it back to the office. It didn't feel like a cheat meal. After a while, it wasn't just about food. It became part of a lifestyle, and people bought into that. The menu had the staples: hummus, tzatziki, grilled chicken, braised lamb, spicy meatballs, falafel. It felt authentic but still fast and modern. And even though the meals were more expensive than traditional fast food, that didn't slow them down at first. If anything, the premium feel added to the appeal. At some point, the leadership clearly decided they weren't going small. It was to go big or go home. But building new locations one by one across the country is expensive, slow, risky. So in 2018, Cava took a different route. They acquired Zoe's Kitchen for around $300 million. Zoe's Kitchen had a similar Mediterranean focus, and it had been around longer, but sales had been slipping. The brand was struggling. Cava didn't merge the brands. They didn't keep both concepts running side by side. What Cava wanted was simple: expansion, a fast and aggressive one, and for it to be done as quickly as possible. Instead of building units one by one, Cava simply converted many Zoe's Kitchens across the country, which were over 250 locations, into Cava restaurants. They bought the infrastructure. Over 250 Zoe's Kitchen locations across the country were converted into Cava restaurants. That's how you expand fast. Instead of starting from scratch in each market, they rebranded existing spaces. It saved time, it reduced some of the risk that comes with entering new markets, and it eliminated a direct competitor. One move, massive expansion. Suddenly, Cava was everywhere. New neighborhoods, new cities, more visibility, and growth fed growth. The menu expanded, the brand got louder. Then came the next big step. By 2023, the IPO market had cooled off. In 2021, more than 1,000 companies went public. In 2023, 2023, that number dropped to about 150, less than 20% of what it was during the boom. Then, Cava went public in June 2023. At first, this was one of the good times, but in just a short amount of time, things went south. The initial offering price was $22 per share. It opened at $42. It closed that first day at $43.78. At the time, it was the top-performing IPO. The opening price was nearly double the offer price. Demand was strong. Some would argue the shares were underpriced. They raised roughly $300 million by offering about 14.4 million shares. The implied valuation at debut was close to $5 billion. That was the high point. Marketing ramped up. Digital engagement increased. They rolled out more tech inside the business. There were loyalty program discussions. The brand leaned hard into community building. Sales were strong. More stores kept popping up. That $18 bowl was everywhere. What started as a local restaurant in Maryland had turned into a national chain. But highs don't last forever. Eventually, the momentum slowed, and what looked like a movement started to look more like a trend. At first, Cava positioned itself as inclusive, food for everyone. Most of its customers were young people, students, entry-level workers, middle-income earners who could justify an $18 bowl every now and then. But over time, prices crept up. Slowly, food for everyone started to feel like food for a specific group. This high eventually reached an all-time low, and the realization that this might have been just a trend rather than a revolution started to set in. A revolution is only sustainable if it remains inclusive and easily accessible to all. In the beginning, Cava operated by the policy of inclusivity and food for all. Then, inflation kicked in. When budgets tightened, that $18 meal became easier to cut. Students and younger workers started prioritizing rent, gas, and groceries. Cava began to feel like a luxury. Sales felt it. Usually, when people start to struggle to afford basic things, they turn away from things that aren't basic to their needs and survival. Eating out and buying these $18 bowls started to feel more like a luxury than an easy thing for them. At the same time, investors were assigning high multiples to the company. Expectations were aggressive. Rapid growth was assumed. One thing businesses shouldn't take lightly is the macroeconomic risk of operating. And as great as Cava was doing, it wasn't immune to it. These are typically external factors that can hamper a business's growth. When inflation accelerated, growth slowed. Sales cooled. The stock price pulled back. Valuations compressed. This was not what many investors expected for Cava. They believed that because of its successful IPO and continuing sales growth, it would continue to perform well. And while this was happening, competitors adjusted. McDonald's rolled out value meals. Other chains pushed $5 deals, 2-for-1 promotions. This was a response to the economic climate at the time and a strategic move on their part to stay relevant. But Cava didn't follow. The company held its pricing, no major discounting. The CEO said they wouldn't dilute the brand by offering discounts. He described the environment as a macroeconomic fog and suggested they would wait it out. But inflation wasn't just fog, it lingered. Despite that, they remained steadfast in their decision not to raise their prices, which ultimately backfired on them. Their stock prices took a massive hit. Fast forward to 2024, tariffs and ongoing trade tensions emerged. For a brand built around fresh Mediterranean ingredients, supply chains matter. Many ingredients were locally sourced, but tariffs and trade disruptions still created pressure. Expansion plans slowed, construction stalled, capital got tied up. However, inflation isn't the only macroeconomic factor that can affect a business. Some other things, like government policies and global wars. But in this particular instance, it was the tariffs and global trade wars that emerged during the Trump administration, which is still ongoing. Add to that the broader economic split, a K-shaped economy where higher earners continue to grow wealth while lower earners struggle. In that kind of environment, premium fast casual brands become more niche. Cava started catering more to the upper middle class than to everyone. This wasn't what they promised at the start. It was starting to look like there was a disconnect between where they started and where they were now. At its peak, everyone wanted in. The stock was hot. The brand was everywhere. It was a movement. People weren't letting it pass them by. The brand was also very strategic in its expansion plans. Cava's takeover of Zoe's Kitchen laid the foundation for where they are now. Their growth has slowed. The momentum isn't what it used to be. Their stock has fallen about 71% from its highs. And just like that, their $10 billion dream went down the drain.